All right, let's get started. So it looks like you've been gathering some intel on the Australian economy, huh? Getting ready to maybe make some moves, especially with fixed income products. Well, let's dive into these reports you've got, see what we can find.
Yeah, it is a pretty wild world out there right now in the financial markets, wouldn't you say? Especially with all the moving parts in the Australian economy.
Oh, absolutely. And just looking at the Edge report from December 12th, 2024, I mean, inflation and interest rates are really all over the place. What's the risk that those swings are going to knock an investor right off their feet?
Oh, the risk is very real if they're not careful. These kinds of economic changes can really throw a wrench in your investment plans, especially when it comes to fixed income. I think we should break down how each product reacts.
Yeah, let's do that. Let's start with recommendations.pdf, and it talks about inflation-linked bonds. I mean, they sound good in theory, but how effective are they really at protecting your investment from rising inflation?
Well, think of it like a boxing match, where your returns can kind of adjust to the punches inflation is throwing. That's kind of what these bonds do, right? So both your principal and the interest payments you get, they're indexed to inflation. That way, your purchasing power doesn't take too much of a hit.
Okay, so that sounds like a pretty smart strategy for anyone who's, worried about their returns getting eaten away by inflation. Now, what about floating rate bonds? Those interest rates are always changing, it seems like. I mean, is that good or bad?
It can be both. It really depends. Their interest rates are tied to a benchmark, like the BBSW, which is kind of like the weather vane for the economy, you could say.
Yeah.
So if inflation goes up, the BBSW usually follows, and that could mean higher interest payments for you.
So it's a bit more a bit more of a risky situation, but maybe higher rewards.
Yeah, I'd say it's more like high potential. It could mean more gains when interest rates are going up, but it can also mean losses if those rates take a sudden turn. Really depends on how much risk you're comfortable with.
Right. Okay, so the Edge mentions that bond traders are talking about potential interest rate cuts coming from the Reserve Bank of Australia. If that happens, how do you choose between short-term and long-term bonds? It feels like that's where it gets kind of tricky.
Well, you could think it this way. Short-term bonds are they're like speedboats. They can turn quickly. So if those rate cuts do happen, they mature fast, and then you can reinvest potentially at those higher rates and really ride the wave.
I like that analogy. So what about long-term bonds? Those are more like I don't know, cruise ships. Steady, but maybe not so good at turning quickly.
Yeah, exactly. They can offer pretty nice yields if the rates stay low,
Mm.
but they're definitely more vulnerable if those rates suddenly rise. It's all about picking the right boat for the economic conditions you're sailing into, and that's where understanding duration risk comes into play.
Duration risk. Okay, I'm intrigued. Give me the rundown on that.
Basically, it's how sensitive a bond's price is to changes in interest rates.
Mm.
So the longer the maturity of the bond, the higher the duration is, and the more its price could go up or down if those rates move. Like the difference between a little sailboat getting tossed around in the storm versus a giant tanker. Yeah.
Okay, I get it. So longer term bonds might offer better yields, but they're also a little riskier in rough seas. Now, recommendations.pdf also mentions Australian government bonds. I feel like those are kind of the anchor of a portfolio, right? Super stable.
Yeah, they're often seen as the safe bet, especially with the Australian government's budget being pretty substantial at $734 billion, according to The Edge. Gives investors a reliable income stream, not a lot of risk.
All right, so those are good when you're looking for stability, but then the edge throws in this whole other factor. China's economic troubles, you've got slowing consumption, unemployment's rising, and their property sector is looking pretty shaky. How could all that impact Australia, especially in terms of trade?
That's where things get really interesting and maybe a little choppy. China's a huge trading partner for Australia, so any kind of slowdown over there can definitely create some headwinds for Australian companies.
Okay, so it's not just about what's going on inside Australia, but also those global economic currents. And speaking of currents, the Edge brings up tariffs. It seems like people are always going back and forth on that issue. What's the latest there?
Oh, yeah, it's a hot topic for sure.
Yeah.
There are definitely people who think tariffs are really important for, protecting domestic industries from getting crushed by foreign competition. They see them as a way to protect jobs and really boost local production, kind of like building a strong seawall to protect the coastline.
Right. And The Edge even quotes someone saying that tariffs are necessary to counter things like currency manipulation, which some countries do. Their point is that without tariffs, those practices could give foreign companies an unfair advantage and hurt local businesses.
Yeah, and that's an argument that a lot of people agree with, especially those who are, worried about protecting local jobs and businesses. They see tariffs as kind of a shield against unfair competition.
But then there's the other side of the argument, right? Those who think that tariffs end up hurting consumers and businesses in the long run. The Edge mentions that perspective too.
Right, right. They argue that tariffs usually make things more expensive for consumers. Yeah. Because those costs get passed along. And when prices go up, people spend less, and that can actually slow down the whole economy. It's almost like a boomerang,
Yeah.
intended to protect, but it ends up causing harm.
Yeah, yeah. And it's not just consumers who feel it either. The Edge points out that businesses who depend on imported goods for their production process, they get hit with those higher costs too. It cuts into their profits and can even lead to job losses.
Exactly. It's a very complicated web of consequences. I think it's fair to say that there are strong arguments on both sides. The best approach to trade policy is probably somewhere in the middle, weighing the benefits against the risks carefully.
Okay, so it's a bit of a tightrope walk, trying to find that balance between protecting your own industries but not creating all these other problems. But I mean, how do you even start to untangle all those competing interests?
It takes a lot of nuance for sure. You have to look at the specific industries, how it might impact consumers and businesses, and even the bigger geopolitical picture. And The Edge even brings up how tariffs can increase tensions between countries, potentially leading to, retaliatory measures, even trade wars.
Trade wars. That sounds a little intense, doesn't it?
It can be. And history shows that nobody really wins in a trade war. Global supply chains get disrupted, uncertainty for businesses goes up, and in the end, everyone's economic growth gets hurt.
Okay, so maybe a more careful approach is the way to go. Now, back to China's economic situation. The Edge paints a pretty bleak picture with all the details about slow consumption, rising unemployment, and that struggling property sector. Given all of that, how do you think China's going to approach trade, and especially the relationship with Australia?
That's where things get even more complicated. China's economic problems might make them more aggressive in their trade policies as they try to protect their own industries and keep things stable at home.
So you're thinking maybe more tariffs or other protectionist measures to shield Chinese businesses?
Yeah, it's definitely possible. If China feels like they're in a vulnerable spot economically, they might start putting their own interests first, even if it puts pressure on their trading partners like Australia, like battening down the hatches and focusing on their own ship stability.
Which could make things rough for Australia, since we rely so much on exporting to China.
Exactly. Any disruptions to that relationship could have a big impact on Australian businesses, even the whole economy. And some industries, like mining and agriculture, they depend heavily on the Chinese market, so they'd really feel the effects.
Okay, so that's something to watch closely for sure. Now, switching gears a bit, The Edge has this interesting piece about the U.S. Apparently, the incoming president, President-elect Trump, is looking at ways to make it easier to approve big investment projects, like fast-tracking environmental approvals for companies investing $1 billion or more in the U.S. Is that a good idea or is that risky?
Well, it's a bold move for sure, designed to attract investment and get the economy growing faster. The idea is that if you make it easier for companies to invest, cut through the red tape, then the U.S. becomes a more attractive place to put their money. And that leads to more jobs and a stronger economy.
Right, so it's a pretty classic pro-business approach. But The Edge also mentions that the previous administration, the Biden administration, they actually put a record number of regulations in place, like filled more pages in the Federal Register than any other president. What was their thinking there?
The Biden administration had a different set of priorities. They were focused on things like protecting consumers, safeguarding the environment, and promoting social equity. So their approach was more about putting rules and safety nets in place within the economic system.
So we're really seeing two very different approaches here. One that wants to remove regulations to boost growth, and another that wants more regulations to address risks and protect certain interests.
Exactly. It's an ongoing debate that reflects different ideas about what role the government should play in the economy. Those who favor deregulation believe that less government interference means more innovation and growth driven by the market, while those who favor regulation emphasize the need for oversight to make sure things are fair, to protect vulnerable people, and to reduce risks.
It's interesting to see those different approaches play out, isn't it? And it definitely adds another layer of complexity to the global economic landscape that investors have to consider.
Absolutely. It's always changing. Staying up to date on those different viewpoints and what they might mean is really important for making good investment decisions.
Now, going back to Australia, The Edge makes an interesting point about how hard it is to compete with countries like China, especially those with more centralized control over their economies. It suggests that the usual tools, like changing taxes, spending, or selling assets, might not be enough. What are your thoughts on that?
It's a really thought-provoking argument. The article basically points out the challenges that democracies face in a globalized world. They have to balance a lot of different interests and work through complex political systems, which can make it hard to react quickly to economic problems.
So you're saying that democracies are at a disadvantage when they're competing with more authoritarian systems that can, control their economies more directly.
It's not necessarily about being at a disadvantage. It's more about recognizing that each system has different tools and limitations. Democracies rely on building consensus and having checks and balances, which can slow things down but also make them more transparent and accountable. Authoritarian systems can often make decisions and enact policies much faster, but they might not be as transparent or accountable.
Yeah, it's a tough issue with no easy answers. And it definitely makes you wonder how democracies can best compete and succeed in this ever-changing world.
Absolutely. It's a conversation we need to keep having. But for now, let's shift our focus back to those fixed income products and how they might fit into an investment strategy tailored for the Australian economy. That was, after all, what we started with.
Great point. Let's head over to part 3 and dive into those options. Stick with us.
All right, so we're back. And I'm really interested to get into these different views on tariffs that the Edge talks about. It's like we're about to walk into a room full of economists who are all ready to argue. Oh yeah, it's definitely a topic where people have strong opinions on both sides. So on the one hand, you've got those who see tariffs as absolutely necessary for protecting domestic industries. They say that tariffs can help level the playing field against foreign competitors, and that can protect jobs and ultimately lead to stronger economic growth.
Right. And The Edge even has a quote from someone who believes tariffs are necessary to counter things like currency manipulation, which some countries engage in. They're basically saying that without tariffs, those practices could give foreign companies a real leg up and hurt domestic industries.
Yeah, it's a viewpoint that resonates with a lot of people, particularly those who are concerned about protecting jobs and businesses in their own country. They see tariffs as a way to shield themselves from what they perceive as unfair competition.
But then you've got the other side of the coin, right? The folks who believe that tariffs are more like economic roadblocks that ultimately end up hurting consumers and businesses. The Edge captures that perspective as well.
Oh, absolutely. This group argues that tariffs often lead to higher prices for consumers because those costs get passed down the line. And of course, higher prices mean people have less money to spend, and that can potentially slow down economic growth. It's kind of a boomerang effect, intended to protect, but ends up causing harm.
And it's not just consumers who feel the pain either. The Edge points out that businesses that rely on imported goods for their production process can really get squeezed by those higher input costs. I mean, those increases can eat into their profit margins, could even lead to job losses.
Exactly. It's a really complex web of consequences. I think both sides of the tariff debate have some valid points. The ideal approach to trade policy probably lies somewhere in the middle. Carefully considering the potential benefits and the risks.
Okay, so it's almost like walking a tightrope, right? You have to find that balance between protecting your own industries without setting off a chain reaction of negative consequences. But how do you even begin to figure out where that balance point is with all these competing interests?
It takes a nuanced approach, that's for sure. You have to look at the specific industries that are involved, the potential impact on consumers and businesses, and even the broader geopolitical implications.
Yeah.
And The Edge also mentions how tariffs can escalate tensions between countries, potentially leading to retaliatory measures, even full-blown trade wars.
Trade wars. That sounds a bit scary, doesn't it?
It can be. And if we look back at history, we see that trade wars rarely have winners.
Yeah.
They disrupt global supply chains, increase uncertainty for businesses, and ultimately everyone involved ends up with slower economic growth.
Okay, so maybe a more measured, thoughtful approach is the way to go. Now let's zoom back in on China's economic situation for a minute. The Edge really paints a pretty stark picture of what's happening there. You know, talking about sluggish domestic consumption, unemployment going up, and that troubled property sector. So, given all those internal challenges, how do you think China might approach trade in general, and specifically their relationship with Australia?
Well, this is where the domestic economic situation and the international picture really come together.
Hmm.
China's internal problems could lead them to take a more aggressive stance on trade as they try to protect their own industries and maintain stability.
So are we talking about potentially more protectionist measures? You know, things like tariffs to try and safeguard Chinese businesses?
Yeah, it's definitely a possibility. If China starts to feel, economically vulnerable, they might put their own interests first, even if that puts pressure on their relationships with trading partners like Australia. It's like battening down the hatches and making sure their own ship is stable in a storm.
Right, which could mean some pretty rough sailing for Australia considering how much we rely on exporting to China.
Absolutely. Any disruptions to that trade relationship could really ripple through the Australian economy, impacting businesses across the board. And, some sectors in particular, like mining and agriculture, those that rely heavily on the Chinese market, they would really feel those effects.
Yeah, definitely something to keep an eye on. Now, shifting gears a little bit, The Edge also highlights an interesting development in the U.S. Apparently, the incoming president, President-elect Trump, is planning to streamline the process for approving large investment projects, including fast-tracking environmental approvals for companies that invest like $1 billion or more in the U.S. Is that a smart move or is that kind of risky?
Well, it's a bold move, that's for sure. It's designed to attract investment and stimulate economic growth. The thing is that if you make it easier for companies to invest, cut through the red tape, then the U.S. becomes a more attractive place to put their money, and that leads to job creation and a boost to the economy.
Right. So it's a pretty classic pro-business approach. But The Edge also points out that the previous administration, the Biden administration, they actually implemented a record number of regulations. Like they filled more pages in the Federal Register than any previous administration. What was the reasoning behind that approach?
Well, the Biden administration had a different set of priorities, often centered on things like consumer protection, environmental safeguards and social equity. So they were more focused on setting up guardrails and safety nets within the economic system.
So we're really seeing two very different philosophies here. One is focused on deregulation to try to unleash economic growth, and the other is all about regulation to address potential risks and protect various interests.
Exactly. It's a classic debate that really reflects different views on the role of government in the economy. The deregulation camp believes that reducing government intervention allows market forces to drive innovation and growth, while the pro-regulation camp emphasizes the need for oversight to ensure fairness, to protect vulnerable populations, and to mitigate risks.
Yeah, it's fascinating to watch these different approaches play out in the real world, and it definitely adds another layer of complexity to this global economic picture that investors have to navigate.
Absolutely. It's a constantly evolving ecosystem. Staying informed about those different perspectives and what their potential consequences might be, it's really important for making smart investment decisions.
Now, going back to Australia for a moment, The Edge presents a pretty thought-provoking perspective on the difficulties of competing with countries like China, especially those that have more centralized control over their economies. It suggests that the traditional tools that governments use, like adjusting taxes or spending or selling assets, might not be enough. What are your thoughts on that?
It's a really interesting argument, for sure. What the article highlights is the inherent limitations that democracies often face in a globalized economy. They have to balance competing interests and navigate complex political processes, which can make it difficult to respond quickly or decisively to economic challenges.
So are you saying that democracies are at a disadvantage when they're competing with more authoritarian governments that can exert more direct control over their economies?
It's not necessarily about being at a disadvantage. It's more about recognizing that each system operates under different constraints and with different tools. Democracies rely on building consensus and having checks and balances, which can slow down the decision-making process, but it also provides greater transparency and accountability. Authoritarian regimes, on the other hand, they can often make decisions and implement policies very quickly, but they may lack that same level of transparency and accountability.
Yeah, it's a really complex issue with no easy answers, and it definitely raises questions about how democracies can best position themselves to compete and thrive in this changing global landscape.
Exactly. It's a conversation that needs to continue. But for now, let's bring our focus back to those fixed income products and how they might factor into an investment strategy that's it's specifically designed for the Australian economic environment. That was, after all, the starting point for our deep dive today.
Great point. Let's set sail for part three and explore those options further. Stay with us.
All right, welcome back to the deep dive. We've been really charting a course through the Australian economy, haven't we? Looking at everything from fixed income products to those global trade winds and of course all the choppy waters created by China's economic slowdown.
Yeah, it's been quite a journey so far,
Yeah.
but now I think it's time to circle back to where we started, those fixed income products that you're considering. So, given everything we've talked about, how can we find a strategy that works for you, aligns with your goals, and how much risk you're comfortable with?
Exactly. Let's say someone's really looking for that rock solid stability, especially with all the economic uncertainty out there. Are Australian government bonds still the safest bet? They're definitely still a top contender. Remember, they're backed by the Australian government's budget,
Yeah.
which is pretty substantial. So they offer a reliable income stream, not a lot of risk. You can think of them as the foundation of your fixed income portfolio.
Okay, so solid and dependable. That's good. But what about investors who are more worried about inflation eating away at their returns? Where do inflation-linked bonds come in?
Those are your inflation protection. They're designed to keep you afloat when prices start rising. So the principal and the interest payments, they adjust based on inflation, making sure that your purchasing power doesn't get washed away.
Okay, got it. So if you're worried about inflation, those inflation-linked bonds are like a built-in life preserver. Now, we also talked about floating rate bonds. Those seem a little more a little riskier maybe, but with the potential for higher returns if interest rates go up.
Yeah, think of those as your high-speed boats. They can ride those waves of rising interest rates and potentially deliver bigger returns. But you have to remember they can also be more vulnerable if those rates suddenly change direction.
Okay, so with floating rate bonds, you might be catching bigger weights, but it could also be a bumpier ride. So really, choosing between these different fixed income options comes down to figuring out how much risk you're willing to take and what your investment timeline looks like.
Exactly. There's no one perfect solution for everyone. The best strategy depends on your own situation and what you're hoping to achieve.
Yeah.
Are you looking for those steady returns with low risk, or are you willing to ride some waves for the chance of higher gains?
Right, right. And we can't forget about all those global factors we discussed, right?
Yeah.
China's slowdown, trade tensions, currency fluctuations, all of those things can create some unexpected turbulence that can affect even the most carefully planned investments.
Absolutely. It's crucial to stay informed about what's happening in the world and how it might impact the Australian economy. Diversifying your portfolio, having a mix of domestic and international assets, that can help create a more stable overall picture.
Diversification, that's the key. So as we wrap up our deep dive here, what are the most important things our listeners should take away from all this?
Well, here's your compass for navigating the Australian economy. First, you need to understand the economic climate, right? Inflation, interest rates, geopolitical risks, all of that. Second, you got to figure out what you want to achieve with your investments and how much risk you're comfortable taking. And third, you need to choose the right mix of fixed income products that align with those goals and your risk tolerance.
Great advice. And of course, it's always a good idea to talk to a qualified financial advisor. They can help you, really fine-tune your strategy and make sure you're ready for whatever comes your way, whether it's smooth sailing or a bit of a storm.
Absolutely. Think of them as your experienced guide, helping you navigate those tricky financial waters.
Well, that brings us to the end of our deep dive into the Australian economy. We've explored the currents, charted the courses, and hopefully you feel a bit more equipped to navigate these waters on your own.
It's been great to set sail on this journey with you.
And a huge thank you to all our listeners for joining us. Just remember, the best investment strategy is one that's well-informed and tailored to your individual needs and goals. So keep learning, stay curious, and bon voyage on your investing adventures.